The qualified business income deduction is one of the best tax planning moves out there, and it's exclusively for those with pass-through entities. So if you own an LLC, an S Corp, a partnership, etc., you need to understand what the qualified business income deduction is. Before we walk through some examples, I need to help you understand truly what it is, because it's not simple, and that's exactly why most business owners and even most financial planners have no idea how to help you plan around it. I made this infographic for you to look at to help walk you through it. And I really want you to focus on this left side of married filing jointly. You know, the numbers just slightly change if you're single or you're married filing joint. But what you first need to understand is, if you look at this chart, the qualified business income deduction is 20% of your business profits early on. So for married filing joint, if your taxable income is under $383,000, it's super simple. You get a deduction of 20% of the business profits. And then there's this period of time where you're in a phase out. From 383.9 to 483.9, you have a slight reduction. And then after that, the equation changes. So there's a few things you need to know here. The first one is what an SSTB is. So this is a specified service and trade business. If you are an SSTB, then you no longer get the qualified business income deduction. So who's an SSTB? Consultants, outsourced marketers, financial planners, doctors, etc. Anybody where it's really a service business, you no longer get this deduction. But if you are not an SSTB, then you have to understand what the equation is. So if you look right here, it becomes really confusing. It's the lesser of 20% of business profits or 50% of W-2 wages. So this is really important when you're trying to figure out how to maximize it. In the beginning, it's 20% of business profits. Then there's a phase out. And then when your income is above $484,000, it becomes the lesser of 20% of business profits or 50% of W-2 wages. So now that you understand how the qualified business income deduction works, let's look at an example of a similar situation to a client that I would be working with. I went through our tax planning software, and I'm gonna basically go through the same income but different salaries. The example is solo business owner. They're the only one being paid wages. They're an S Corp, and they do about $1 million of profit before they pay themselves. On the left is an example of somebody who's told, hey, pay yourself the lowest reasonable wage. Just pay yourself the $150,000 so you can save on some self-employment taxes. Because at the end of the day, most people, the only thing they think about with S Corps is how to lower self-employment taxes. But self-employment taxes are only one part of the story. So let's go through this example. So $150,000 in wages, $850,000 in business profits. So if we go down here, that's total income of $1 million, and we look at the qualified business income deduction. In this example, you'll see here it's $75,000. How did we get to this number? Well, we had to look at the lesser of 20% of business profits or 50% of W-2 wages. So if we go back up here, right, 850,000, 20% of that, we don't really have to do the math, but it's a little under $200,000. But if we go to the W-2 wages, 50% of that is $75,000. And again, since it's the lesser, you only end up being able to take this $75,000 deduction. This means you're leaving a lot of money on the table, right? $75,000 is here, but you have the 20% of business profits is way higher. How do you optimize this? Well, you want to get these a little bit closer, right? You want to reduce profits and you want to increase salaries. This isn't perfectly fine-tuned, but it's pretty close. So if instead this business owner had a good financial planning team, and at the end of the year they said, wow, business profits are looking really good, let's pay myself a bonus. So if this person would pay themselves a bonus of $135,000, let's see the impact. We go down, business profit is reduced by that amount, so now we're at $715,000. And look at this qualified business income deduction. You now get $142,500 in deductions versus $75,000. This person making $1 million is in the 37% tax bracket. So they got just under a $70,000 added deduction at the 37% tax bracket. What is the long-term impact of this? So if we look here, the difference of this is basically just under $25,000 of tax savings. This isn't the whole story, right? There's a little bit more self-employment taxes, but at the end of the day, this person will save over $20,000 in taxes just because they optimized the qualified business income deduction. Let's think about a couple other examples. I'm not going to use the software here to go into it, but let's look at an example of somebody who makes $200,000 and they are an S corp. $200,000, let's say you have 100,000 salary, 100,000 of business profits. Well, at the end of the day, no matter what, you get 20% of business profits as the deduction. 100,000 of profits, $20,000 deduction. This is where a lot of people look and say, well, should I pay myself less so I have a higher profit? Well, at the end of the day, you can't really do that. The IRS says you need to have a reasonable salary, so you can't just pay yourself $10,000 and take $190,000 in profits just to maximize that deduction. But if we look at a different example and say, hey, you're a partnership, or you're a sole prop, not an S corp, and you have $1 million of income, well, then you have to understand, well, you have no wages, right? You have $1 million in profits, 0 in wages, so you get a $0 deduction. Versus if you were the S corp, you paid yourself the wages, reduced profits, and you maximize that qualified business income deduction, you would end up getting that deduction very similar to the one we just talked about of about $170,000. The qualified business income deduction is one of the best tax planning moves that you have, but you have to do the planning around this, and you have to do it on a yearly basis. This could mean running bonuses at year end to increase salaries. It could be, at the end of the year, making sure that you somehow reduce profits, maybe through profit sharing or some other different situations, but you need to plan around this. So to recap, qualified business income deduction, 20% of business profits until your AGI gets high enough where it becomes the lesser of 50% of W-2 wages or 20% of business profits. Again, whichever is lesser. Plan around this, optimize it, and work with your team to make sure this gets done on a yearly basis. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.